The stock market has always been a tricky thing to maneuver in. There is a lot of risk involved in losing your money if you put it in the wrong stocks. But what if we told you that you can use the market's fluctuations to your advantage and be able to make good decisions as a result? It's a goal for a lot of investors to win in the stock market and make good choices when it comes to investing their money. It's always in your benefit to know more about the stocks that you'll purchase and how valuable they will be in the future. This is Intelligentsia, your life advice for practical and financial goals. What we want to talk about today is the value of investing and value investing. A lot of people want to make their money work for them, but how does that happen through investing? Well, when you buy a stock, you essentially buy a part of a business, and if that business does well and grows as a result, you either get paid through dividends or the stock you own in that business increases in value. How you make money off of it is through appreciation or dividends over time, and the more you buy stocks, the more you get in assets. The goal here is to own more over time by continuing to invest and compound your stocks. It's a fairly manageable way of making money from your money, and anyone with the right know-how could do it. But what we want to do is to maximize our money and be able to buy low and sell high. But how do we do that? Through value investing. Value investing is a type of investing strategy where you buy undervalued stocks in hopes of them becoming more valuable over time. The idea here is that the market sometimes misprices certain securities, and it causes the market price of stocks to be lower than what they should be. If you're a value investor, what you want to do is to capitalize on what are essentially discounted rates. Warren Buffett, one of the richest men in the world, once said, "Price is what you pay, value is what you get." And this is a man that got his start from value investing. It just means that the price isn't always the most important indicator at the start of a stock's life cycle. And it's possible that with the right knowledge about the sector you're planning on investing in, you may be onto something more valuable than what it's currently worth. An example of this is Netflix. Did you know that more than 10 years ago, Wall Street was ready to ditch Netflix due to poor business practices? And now, their stock has risen more than 1,000%. If you were an investor then, and you were knowledgeable enough but believed that online streaming would be the future of entertainment, you would have gained a lot more than what you've initially invested. If you're someone that likes to buy cheap stocks and hold them for a long time, value investing would be the right move for you. Normally, you'd want to move against the market in order to win big over time. Value investing involves a lot of betting against trends, hoping that the market adjusts and the investment thesis plays out. The idea here is that you're buying unpopular stocks for cheap prices, and understanding that they may provide you with huge returns when the market favors them again. It involves a lot of long-term holding, focusing on fundamentals like checking a company's financial health, and understanding how trends affect the businesses that you support. As a result, value investors normally don't spend a lot in terms of transaction costs because their investing style does not trade as much. If you're someone that relies solely on short-term market trends, then value investing may not be for you, as this approach tends to only work for those who prefer holding rather than trading regularly. Warren Buffett also said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This approach states that you have to understand that what you're investing in is a good company that sells stock for cheap. The quality of a company you're investing in is important. What you need to know for the most part is that they're consistently earning, have strong competitive advantages, and have excellent management. Understanding a company's intrinsic value, looking at the long-term perspective, and being willing to go against the market are all fundamental principles that the value investor needs in order to make the most out of their investment. Now, we're not telling people to predict the future, but it's also important to study trends and be informed of current events. Investing in newer technologies in the age of information has always been the right call for the most part. Buffett also mentioned that it's never paid to bet against America. There's always room for growth when investing for the good of the economy. If you're someone that invests your money in companies that bring value to society and are managed well, chances are you can be sure that your investment will grow over the years as you watch. As technology and economies evolve, stock prices will change with them. Not all companies perform the same over the course of decades, and what you want to do here is to understand buying cheap stocks to sell high at a later date, preferably more than a decade, can give you big returns. You can name big companies nowadays like Tesla and Nvidia, and you can know that in the past 10 years, they've grown their stocks substantially. If you bought $1,000 worth of stock from Tesla in 2011, you would have had $204,000 now. You buy stocks for cheap and sell them for a huge return after a few years. There are a lot of different ways to get here, and understanding that it takes time, patience, and knowledge can go a long way. That said, we'd like to talk about what to avoid when going for this type of strategy. Since you'll need to be patient and hold for an extended period of time, it's wise to avoid overtrading. You wouldn't want to neglect a company's quality just because their stock prices are cheap too. It's important to understand why their stock is cheap, and it's possibly due to a reason that may affect their growth in the long term. Just because a stock's price is falling, it doesn't always mean that you should automatically be there to buy it. Thorough analysis of the reasons as to why a company's stock price is plummeting could be because of internal management issues. It's also possible that due to the market evolving and favoring new technology, that some companies just go down. Maybe it's due to technological shifts, maybe it's due to differences in consumer behavior, or maybe it's due to poor leadership. Economic trends, inflation, and interest rates also affect how a stock's price can go for, and knowing that helps you a lot in making your decision. Ultimately, the value investor focuses on fundamentals rather than emotionally trading stocks. Just because the market fluctuates doesn't mean you have to fluctuate with it. Value trading requires a lot of patience, and some days you may be tempted to sell once you gain enough value just to be able to make a profit. Tangible growth in this strategy is only possible if you're willing to be consistent in holding and understanding what kind of business you're putting your money into. New information over time becomes available to investors, and it's up to you to study up on them. Understand the impact it could have on the sector you're supporting, and know that you'll come out on top in the long run because you understand and have studied the company you're investing in. There are a lot of potential pitfalls in investing, but as long as you commit to the strategy and you trade in moderation, you'll be successful. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.